Hey guys, it is Julie here with TipRanks. In today's video, we're taking a look at two dividend-paying stocks. Now, both of these stocks have a dividend yield around 7%, but they also come with a couple buy ratings from analysts that believe they have some solid upside potential on the horizon as well. So we're going to take a closer look at these companies, what it is that they do, and what those analysts are predicting for their future. Just before we get into that, this is your friendly reminder that if you enjoy today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Don't forget to check out Richard Allen's Power Hour at 3 p.m. Eastern Standard Time on weekdays to get up to date with what's been going on in the market throughout the day. All right, with that being said, let's get right into these two dividend-paying companies, starting off with Blackstone Mineral. Blackstone Minerals trades under the ticker BSM, and they're currently priced at $10.15 per share. They pay a quarterly dividend of 17 cents per share, which works out to a current dividend yield of 6.94%. That's compared to the sector average of 3.15%. They just recently had their latest payment on May 21st, so we'll see the next one coming in about 3 months. Blackstone Minerals is a hydrocarbon exploration and development company. The company holds rights to more than 20 million acres spread across 60 productive basins in 40 different states. The lion's share of the operations are spread from Texas through Alabama, but Blackstone also has rights in hydrocarbon production in Montana and North Dakota, West Virginia and Pennsylvania, and the Rocky Mountain states. Their 20 million gross acres of opportunity leads to organic growth with no incremental capital requirements. They have broad exposure to new discoveries and development activity, and with an acreage in every resource play, they have large positions in several of the most active resource plays. The economic benefit of minerals is oil and gas exposure with no operating cost or capital spending requirements, direct benefit from technology advances to enhance recovery in well economics. It represents perpetual call options on future oil and gas development activity, and their scale facilitates opportunities to partner with operators to initiate or accelerate drilling. Blackstone is well positioned to capitalize on a market recovery. They recently announced a $20.7 million acquisition that they funded with equity and cash. In 2020, they shifted their focus to strengthening their balance sheet by paying down $273 million of outstanding borrowings. Their outstanding debt at the end of Q1 2021 was down to $111 million. In regards to their dividend, they have a long history of returning cash to their equity holders. And they've had about $3.6 billion returned to investors through distributions over the past 20 years. At the beginning of May, the company shared their first quarter earnings report. And the results did show that the company has not still fully bounced back from the pandemic, as their revenues and earnings are both still down year over year. But on a positive note, their revenues have shown 3 consecutive quarters of sequential increases. Their top line came in at $87.1 million, and net income was reported at $16 million. Covering the stock is analyst John Freeman from Raymond James. And he is impressed, saying that Blackstone Minerals had an incredibly strong first quarter, where it announced another series of development deals in the Austin Chalk and Shelby Trough, as well as its first acquisition since the pandemic. We have already seen phenomenal results in the very early development of the Austin Chalk and expect more meaningful well catalysts in the near term, this time from the Shelby Trough. He summed up that due to this strong progress, we are raising our production estimates for 2021 to the top of their guide and are now modeling a return to growth in 2022. Alongside a soon-to-be growing production profile, BSM offers an attractive distribution yield and a rock-solid balance sheet. John rates the stock a buy with a $15 price target, which would be a 47% upside from their current prices. And there are 3 other analysts that have current ratings on the stock. And while they aren't quite as bullish as John, the stock does come in as a moderate buy. The average price target is $11.75, which would still be a healthy upside of over 15%. The second company on our list is another Blackstone, but this time it is a REIT with Blackstone Mortgage. Trading under the ticker BXMT, they're currently priced at $32.55 per share. They also pay their dividend quarterly at 62 cents per share, which would be a yield of 7.64%. They most recently paid on April 15th, so once again will have their next payment coming out this summer. Now, as I said before, Blackstone Mortgage is a REIT, or real estate investment trust. They are focused on collateral-based senior mortgage loans in the North American, European, and Australian markets. BXMT is sponsored by one of the world's largest owners, operators, and financiers of real estate, and Blackstone is the largest alternative asset manager with $649 billion in assets under management. They have a 35-year investment record, and under their real estate segment, they have assets under management of $196 billion. Their $18.7 billion senior loan portfolio is predominantly comprised of loans on major market assets with top sponsors and is well diversified across asset classes and geographies. As one of the largest owners of real estate in every sector and geography, Blackstone's unparalleled reach across the real estate market drives proprietary insight, which enables best-in-class investment performance. Their current holdings includes a mix of office, logistics, hotel, and residential. Blackstone Mortgage shared their Q1 earnings report at the very end of April. Some of their highlights include that they closed $1.7 billion of new loans in that first quarter, surpassing 2020 total originations and driving nearly $700 million of portfolio growth to a record of $18.7 billion at that quarter end. Their top line came in at $185.75 million, and their earnings per share at 54 cents was up dramatically from the 39-cent loss reported in the year-ago quarter. They also reported that they have a total liquidity of $1.1 billion. Covering their stock is BTIG analyst Tim Hayes, and he notes that their pipeline is robust and management expects earnings to benefit from continued portfolio growth and higher fee income as originations and repayments normalize. Their ROEs on new originations are expected to be in line with pre-pandemic levels as lower funding costs offset pressure on asset yields. Credit performance remains strong and continues to trend in the right direction. They recognized 100% interest collection in their first quarter, with 98% of loans performing. He says that we view shares to be attractively valued, currently trading at a discount to historic multiples and offering that solid dividend. He rates the stock a buy, and his $35 price target would represent about a 7.5% upside potential. Altogether, there are 5 analyst ratings on the stock, with an average price target of $33.75 for a 3.5% upside. On the high end, we do have a buy rating from Donald at Wells Fargo with a 10.6% upside potential. So there we have 2 stocks, both paying dividends of about 7% or higher, with some potential growth in their future as well. Now, I love hearing from you guys, so let me know your thoughts on these 2 stocks, or what other dividend-paying companies are some of your favorite in your portfolio. Please keep in mind that these videos are never a suggestion to buy or sell any specific stock, and are just meant for information and entertainment purposes. Please make sure you're always doing your own research and due diligence before making any investment decision. If you enjoyed today's video, make sure you hit that thumbs up button and that you're subscribed to the channel as well. Thank you guys so much for watching. I hope you have a fantastic day, and we will see you back here next time.